Okay, the book zone people, we had to do this two chapters, chapter 3 and chapter 4, and since I did not get enough time today to get to the con call of this book zone, so let's try and have some sense of the book zone call. So here in chapter 3 he is introducing us to do cash flows and free cash flows. Basically cash flows क्या होते हैं, free cash flows क्या होते हैं. So he says the bottom line of the companies and investors is the cash matters. It is they need to pay the bills, wages, interest, borrowings, dividends to the shareholders. Investors can also use it to spot aggressive accounting by companies with profits with cash flows over a period of time. Time spent looking at the company's cash flows therefore spent usefully for an investor. So this is how a cash flow is made. They take the operating profit, which is definitely before and after tax. You can take it both ways. They add the depreciation on it. They add the profits on disposal. Sorry, they subtract the profits on disposal on some assets. They add the working capital changes, the change in stock, debtors, creditors, provisions, and this becomes the change in working capital and other non-operating activities. They subtract the tax and you guess the cash flow from books. Now what you have to do is you have to compute the cumulative profits versus cumulative cash flows. We'll see that in a bit. Then in the cash flow of investing you have capital expenditure, you buy assets, you sell assets, acquisitions, sale of businesses, interest earned, interest received, and from the financing you have shares issued, shares buyback, so on and so forth. So this is what a cash flow structure looks like. So let's see what a cash flow structure looks like in our screener. Let's open up any random company and this is what the cash flow is all about. Cash flow from operating activities, profit from operations, working capital changes, loans and advances, other working capital changes. So this is the net change in working capital, pay the taxes and you get cash flow from operations. From this you put your money into fixed assets, you sell some investments, you buy some investments, you adjust for the interest received, and interest paid goes down to your cash flow from financing. Here you show how much money you got from shares, how much money you got from borrowings, how much you paid the borrowings back. So this is basically the structure of a cash flow. Now what you have to do is you have to go to businesses like any business. Let's take BC Jewelers as an example. I export the sheet and I get to the sheet. What I need to do is this is my net profit line for the last 3 years or so, or say 14, 15, 16, just doing an example. The cumulative profit is 1132 crores sum over here, but in the 3 years where the cash flow was reported, the cash flow was negative 437 crores. Very damn risky. So this was the indication even before this company went bust and the fraud came out and so on and so forth. If I look at the total net profit of the company till date after adjusting for these losses, it is 1641 crores, but my total cash flow is a minus of 1670 crores. So this business is not generating it is a bogus entity, and you can spot errors or problems in cash flows like this where you sum out the cumulative profits versus the cumulative cash flows. So then he says why profits and cash flows are not the same, because there is a difference of depreciation and interest which is being deducted in the profit is being added back into the cash flows. So my interest and depreciation is this amount which is deducted in my cash flows to come to my PAT number, but these numbers are added to my cash flow from operations number to get to the. So ideally my cash flow from operations should be greater than the PAT, but in this case यहाँ तो बिल्कुल ही उल्टा हो रहा है, right? So this is post tax profit, free cash, difference. So higher the difference in the PAT and free cash flows, the bad it is. Correct. So this is what he is saying over here. Profits are calculated on something known as accruals on matching in sales and expenses. Cash flows are counted as the actual inflow of cash in and out of the business. So why the differences? Depreciation. See, depreciation is an expense in the P&L statement. You don't make any check of depreciation and give it to anybody. It is a point of an estimated cost of fixed assets wear and tear where you need to spend to maintain those assets or increase those assets. So that is depreciation, deducted in P&L, added back in cash flow. Sales on credit, where you have not got the money, that is sales on credit is the way you get the accrual accounting sales and profits, but you don't get the cash because the sales are on credit. So that is why there will be a mismatch in the cash flows. Purchases on credit will be you have taken some inventory, you have not paid for it, so cash will not go out. In this case, cash flow will be more than the profit, right? So these are some of the ways why cash flows will be different. Now, why do companies need free cash flow? Because they've got a lot of expenses like interest payments, debts, tax bills, keep the assets in good working condition, pay for the new assets, buy new assets, do capital expenditure, pay dividends, buy their own shares, repay debt, buy other companies. So these are some of the reasons why companies need cash flow and free cash flow to do the work. Now there are two types of free cash flow: free cash flow to the firm and free cash flow to the shareholders. Now this free cash flow for the firm is basically a point of interest for the person who lends money to the business. We are shareholders, equity shareholders. We are more bothered about free cash flow to the shareholders, which is FCFE in terms, and this is called FCFF. So there is a slight difference in how do you calculate all this. You take the net cash flow from operations, you subtract the capital expenditure, and you add the dividends from joint ventures, not the main firm, the joint ventures to the firm, and you land up on something called free cash flow to the firm. Then what you do is you subtract the dividends you pay out to the minority shareholders, you subtract the interest you pay out on your loans you have, you add the interest which you receive, and you get something which is called free cash flow to the equity. But you don't have to do all this. All this is automatically done in the statement of cash flows. So basically what we do is, we are shareholders, we take this cash flow from operations, adjust it for working capitals and taxes and all, and then what we do is we subtract the fixed asset purchase. Some people, what they do is they will add this fixed asset sold as cash flows, but I don't like to do that because it's better to stay conservative than really go to the last decimal point calculation. This is cash flow to equity and cash flow to firm. See, free cash flow to the firm is not matters to us, it matters to the person who has lend money or a financer for the business. Now you see over there, free cash flow to the firm has high numbers, and see free cash flow to equity is so different. If it is same, it is good enough, but if it is such a different thing to both the things, that means this business is more worried to feed the financiers, not worried about we the equity holders. So why companies produce free cash flow? They are very profitable, they are growing very fast, their profits get converted to cash flows. Why the profits will get converted to cash flows? Because their working capital is working. If their working capital is slow or is getting stuck, their profits will not get converted to cash flows. They spend only small amounts of cash which they generate for few newer assets. That means lower reinvestment rate, which are good businesses. Now what is operating cash flow? Operating cash flow is basically your operating cash conversion. Operating cash conversion is your OCF, which is your cash flow from operations divided by operating profit into 100. This means over here is, if I go to screener and I take my operating cash flows, see my cash flows over here. This I am comparing with this line. It is 332 crores profit, but here my cash flow is 337 crores of loss, which is totally in the opposite direction. So don't go into this business. So now I will show you some business where what was happening. Kaplan Point. Way back in 2012, I think the operating profit was 11 crores, cash flow was 28 crores, double the operating profit. Now I'm just comparing operating profit to the cash flows. The basic operating profit to the firm, because not even to the firm, the basic operating profit of the business, because depreciation and interest is still not accounted for. Then what happened? The operating profit is 22 crores, the cash flow is 32 crores. So wherever you find such, so as I was saying, this business was generating more amount of cash than the operating profit it had. What happened to the stock price? The stock price was 4 rupees, is now 1400 rupees. Wow, massive. So the operating cash flow conversion is your operating cash flows divided by your operating profit into 100, just to see a percentages and how much of your operating profit is getting into cash flows. Very easy to understand, no big jargon over here. This is a pictorial representation. It should be very similar. It cannot be very similar every year, but it should be very similar. Again, this is a model of cash flows. This is net cash flow from operations. All this is provided to us in the screener, in annual reports. We don't need to do this manually, and everything is provided for. This is called your cash flow from operations. See, depreciation and amortization are added back, and profit and loss on disposals, they are added, taken away or added back, depends upon negative or a positive figure. So we want basically the core cash generated by the business. increase and decrease in debtors is added back or taken away. This is working capital change. Again, increase, decrease in creditor. This is also working capital change. Added and taken away depends upon your inward and outward. Same way for inventory. This is your working capital change and adjusted. Amount paid into final salary, pension. Again, a working capital change kind of an item. So, interpreting the operating cash flow ratios. So, higher the better. Very simple. Operating cash flow ratios more than 100 is a sign that you have found a great business. But 100% बहुत कम business में मिलेगा आपको इंडिया में, बाकी मिलेगा नहीं. So he's given some examples of 100% cash flow ratios. Again, he has given some examples where the cash flow ratios to conversion to operating profit to cash flow ratios are less. So this is aggressive accounting, and you can catch loopholes in this. So what is the stock ratio? If you can come across a company with regular cash outflows from increase in stocks, which is when you give ESOPs, when you give stocks as a bonus and all those things. If you come across a company with regular cash outflows from increase in stocks, compare the stock inventory figure of the company's balance sheet with its turnover of revenue. This is basically called inventory turnover, which is there in our sheet, in the Excel sheet. Higher the better. Debtor turnover, how much times it takes for the debtor to we to collect the payments from the debtors, and secondly, similarly, is a creditor turnover, how much time we take to pay to our creditors. Now this is the capex ratio, how much operating cash flows are being used for capex. So higher ROC business will mean that the business is spending less amount of money for capex, and more amount of money is left for the disposal of the shareholders. That is why I go with higher ROC businesses. So these are again some examples, FTSE companies, and a pictorial representation of that. He's talking more examples of companies over there. And then he talks about examples of free cash flow to the firm. We are not interested in free cash flow to the firm. And this ends your chapter 3. I think I was a little fast, but it took me around 2 minutes to get back to this and give you a gist of chapter 3. Examples are PC Jewelers, where you see your cash flows are not matching. Examples are Kaplan Point, you see where your cash flows are over delivering. So you keep a watch on operating profit versus cash flows, and what is the percentage of conversion of operating profits to cash flows. Then you learned about capex ratio, then you learned about inventory turnover ratio, debtor turnover ratio, creditor turnover ratio. Formulas are given in the book, and all this is already done in the Excel sheet which you already have. So hope this helps. Let's move on to chapter 4.